Welcome to the deep dive. Today we're looking at some really interesting source material you shared. It's quite an unconventional take on loan risk and member support in credit unions. And just so you know, this deep dive is brought to you by Access Softtech. They're the premier provider of digital banking solutions. So the core idea here, well, it's pretty challenging actually. It really questions how credit unions typically handle members who run into financial trouble, suggesting maybe we need to move, way beyond just the standard default procedures.
It's exactly right. Yeah, the source is really pushing back on how we usually define risk management for loans. Think about what do credit unions normally look at when underwriting?
Okay, yeah, like income history,
Yeah.
debt to income, credit scores, that kind of thing.
Exactly. We lean heavily on that data, all the stuff before the loan is made.
Right, the upfront numbers.
But here's the thing the source points out. The main reasons loans actually, well, go bad often aren't really reflected in those initial numbers.
Hmm.
It specifically mentions the top three reasons people end up in bankruptcy. Things like losing a job unexpectedly.
Getting hit with huge medical bills or, going through a divorce.
And none of those crises are going to show up on a credit report beforehand, are they? You just can't predict a layoff or a health scare from a FICO score.
Precisely. And the source really highlights this gap. It even jokes, kind of, that with the current approach, you might as well check someone's blood pressure and, I don't know, marital happiness before giving them a car loan.
Huh. Okay. Yeah, that definitely makes the point.
Because those life factors are often the actual triggers for default.
Okay, so if these unpredictable life events are the real risk factors, how does the standard system react when a member does face one of these situations and starts struggling to pay?
Well, right now, the system is mostly built for, let's say, damage control after the problem hits. It's very transactional. If a member defaults, the focus immediately shifts to recovering assets.
Like repossessing the car, for instance, to minimize the loss on the loan.
Exactly. It's about cleaning up the mess after it happens, not really preventing it or helping with the root cause. Right. And this is where the source takes a really unconventional turn. Maybe sounds a bit, I don't know, wild at first. What if, instead of just getting ready to repo that car when someone loses their job, what if the credit union actually, helped them find a new job?
Or, say a member is just swamped by medical debt or dealing with a divorce, what if the credit union stepped in to connect them with financial counseling or other support systems?
It's a totally different approach, isn't it?
It really is.
The source argues this shifts the focus. Instead of just dealing with the result of the life event, the loan default, you're trying to help with the underlying event itself. But let's be real here. Providing job search help or counseling, that costs money.
Oh, absolutely.
So the big question the source brings up, the uncertain part, is would the cost of providing that kind of proactive support actually end up being less than the loan losses you prevent by helping members get back on their feet?
And the source is very upfront about this. It states pretty clearly that we just don't know for sure yet whether the financial savings from fewer loan losses would perfectly balance out the cost of these, support programs. There's a definite financial question mark around the direct ROI.
Right. No guarantees on the immediate bottom line. But, and this is where it gets really fascinating, even with that financial uncertainty just hanging there, the source says one outcome is basically guaranteed.
Which is
The credit union's reputation, its goodwill in the community, that would absolutely soar.
exactly that long-term value.
Hmm.
Members seeing their credit union genuinely stepping up for them during tough times, that builds incredible loyalty. It strengthens the community connection in ways that are, well, hard to put a dollar figure on, but are incredibly valuable nonetheless.
So, what does this all mean for you listening? This source material is essentially proposing a complete rethink of risk management, moving from just assessing factors before you get a loan to actively supporting you, the member, during a crisis that might put that loan at risk. It makes you wonder, what does it mean for financial institutions and maybe for your own relationship with yours if prioritizing member well-being, helping people through life's really hard moments? What if that could be seen not just as an expense, but as a powerful way to manage long-term risk and build a rock-solid reputation? Even if the immediate payback isn't crystal clear, it's definitely something to think about.